I'm Matt Bishar with REIT.com here in New York City for REITWeek 2014. Joining me for this CEO Spotlight is David Neithercut, President and CEO with Equity Residential. David, thanks so much for joining us.
My pleasure. Thanks for having me.
San Francisco, Denver, Seattle, they continue to be your company's top performing markets. What traits do these markets share?
Well, just job growth. Really, our business is all about supply and demand. And these are three markets that have produced some very strong job growth over the past three or 4 years. Certainly Seattle and San Francisco more in the tech space. And in Denver, it's primarily in the energy space. But all of those three markets have been our top performers for the past 2 or 3 years and will continue to be top performers for 2014 as well.
And if you had to pick one of your next level markets that may have the best potential to sort of jump up and join those, what market would that be?
Well, it'd be tough for any market to join those. But this year we're seeing Orange County perform pretty well for us. And you know, Orange County is really a function of what the Irvine company decides to build or not build. But I think Orange County might be one of the markets that would perform very well for us this year.
On the flip side of that, there's Washington, D.C., which continues to be a poor performer. What is it about Washington right now that's causing it so much trouble?
Well, there's just a lot of new supply. So there's 18,000 units expected to be delivered this year and 13,000 delivered next year. You know, in a marketplace that has historically been a fantastic apartment market and one we think over the long term will continue to be a fantastic market. But there's just a lot of uncertainty right now going on in that city about job growth and what's happening in the government, and so there's just been impacted a little bit on the demand side at a time in which we're getting a great deal of new supply. Now that being said, our occupancies there remain very strong. We're getting positive renewal rents with our residents there, but we expect it to be a -1 revenue market this year, probably a little less worse than that in 2015. But we think long term it's going to be a fantastic apartment market. Obviously, it's the government center, and we think long term going to be just fine.
And lastly, can you tell us a little bit about Equity Residential's acquisition and disposition activity?
Well, after many years of elevated activity as we went about transforming our portfolio, in which we probably averaged $1 billion to $1.5 billion every year of dispositions and $1 billion to $1.5 billion of acquisitions, after having closed the Archstone transaction last year, that number will be significantly less. We've given guidance this year of $500 million of buys and $500 million of sales. Looks like we'll be probably pretty close to that. So it's significantly less activity than what we've seen in the past. And in the past, that has really created a lot of earnings dilution for us, and we're pleased to say that going forward now that amount of dilution is behind us, and see no reason why our normalized FFO going forward won't be a couple of points above NOI, and so we're very excited about where our trajectory is going forward.
Great. Well, David, thank you so much for joining us.
My pleasure. Thanks for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.